So this is where we stopped last time, and I was trying to explain to you how to calculate project duration. Let me just do a kind of recap. And I said that project duration represents the average time taken to recoup the amount invested in a project. Company wants to know, okay, when will it take them to recover or to recoup the amount invested in a project? So project duration can be likened to the normal payback period. But the only thing is that the project duration makes use of a present value, whereas the normal payback period does not consider present value in the determination of the payback period. And then not only that, the method you are going to use to compute project duration is different from the method you are going to use to calculate normal payback period. And I said that when you want to calculate project duration, so there are two methods that you can use. You can either use present value method or you use weighted average method. Using the present value method. So before I talked about to explain the method, and I told you, I said that using the present value method, there are three steps you are supposed to carry out. The first step is to determine the present value of each year. Then the second step is to calculate the proportion of the present value to the total present value for each year. Then the third step is to calculate the project duration. Then using the average method or weighted average method. Again, there are there are three steps you are supposed to carry out. The first one is to determine the present value of each year. Then the second step is to calculate the weights. Of each year across all the relevant years. Then step 3 is to calculate the project duration using the relevant formula. So let us have a simple illustration to demonstrate this so that I will use that illustration okay, let's do it this way. Let's use the illustration we have in this question, in the question of Telemundo. Let's use the content of that question to solve for project duration. So in this case, what you are going to pick is just the net cash flow. What you are going to pick is just the net cash flow. So if that is the case, I will then say, let's go back down there. So we want to use this question on Telemundo to calculate project duration. So let's say this is, I would then say calculating using the question about, that is Telemundo. To demonstrate or to calculate project duration. So we want to calculate project duration. Say, for example, we want to use present value method. I would then say calculating project duration. So there is no need for, on the day of your exam, no need for you to say using present value method. Just go ahead and solve the question. All right? No need to say using present value method. But for the purpose of this class, I want to demonstrate the two for you. Whichever one you use, you are going to get the same answer. All right? You will arrive at the same answer. So I will create a column for year, cash flow, discount factor. How much is the discount factor? What's the discount factor for this project that we have when we calculated the NPV?
13%.
13%. Examiner says we should assume 13%. Okay, then. Thank you. Here is 13%. Then I will have the present value. So I need to create a column for the proportion. Proportion of present value. Then I'm going to have a column for duration. So whatever I have as the total duration will give us what we are looking for. So when you are calculating project duration, you don't include year 0. So you ignore year 0. We have year 1, year 2, year 3, year 4. What's the duration of this project? What's the useful life of the project?
5.
5 years. Okay, then. All right. Okay. Total. So I would then go to our workings above. In year 1, what's the net cash flow? If you have it in your note, you can be calling it for me so that it will be faster. So the net cash flow for year 1 is
83.
483. So these are the numbers you want to pick. Okay. Net cash flow is 483. So 483. What's the next one? I know 615. Next one.
674.
674.
937.
937.
1029.
1029 represent the cash flow. That's the net cash flow. So discount factor for year 1 at 13%. What do you have?
0.885.
0.885. Next one.
0.783.
783. Next.
0.693.
653.
93.
93. 693. Next.
0.613.
613 and year 5.
543.
543. At this point, let us calculate the present value. Multiply.
I have a question.
Pardon?
I have a question, sir.
Who is speaking?
It's Prosper.
All right, talk to me.
Sir, is it not possible to use the present value since we already have gotten that in the calculation of the net present value?
Yes, we can do that. It's something we have gotten before, since it's going to be the same answer. So I'm just doing this one as if we are doing as from the scratch. Okay?
All right, sir. Okay.
Yeah, I see we're doing it from the scratch. Oh yeah, multiply for me. What do you get? What's the present value for year 1?
427.
The one is 427.
427.
482.
482.
482.
The 3, 467.
467.
The 4, 574.
574.
The 5, 559.
551. Add it up.
559, sir. 9.
559. Okay. When you add everything together, I think we have
05.
2105. Okay, then. So let us calculate the proportion of the present value to the total present value. That's step 2. No, step 1 says when you are using present value method to calculate your project duration, step 1 says calculate present value for each year. That's what we have done. Then step 2 says determine the proportion of the PV of each year to the total present value. Therefore, what is the ratio of 427 to 2105? That is 427 divided by 2105. What do you get?
0.03.
0.203.
203.
20. What you have in your calculator multiplied by 1 will give us 0.20, right?
Yes, sir.
Then you go to the next one. 482 divided by 2105.
0.228.
2, 3. What you have in your calculator multiplied by 2, what do you get?
0.23.
0.23. Are you sure?
Yes, sir. That's
What
0.8.
what you have in your calculator multiplied by 2,
Multiplied by 2. Okay, 0.4546.
0.46. 467 divided by 2105.
0.221.
0.221. What you have in your calculator multiplied by 3.
0.665.
0.6,
65.
0.67. 574 divided by 2105.
0.276.
0.28. What you have in your calculator multiplied by 4.
1.09.
1.09. Lastly, 559 divided by 2105.
0.227.
0.27 multiplied by what you have in your calculator multiplied by 5.
1.33.
1.33.
33.
So when I add up everything, this one should give me 1. Okay, it can't be more than 1. I should be able to have 143 plus 27. That's 60 plus sorry, what am I saying? Here is 1, 2, 3, 4, 5. This is more than 1. Check again. This is more than 1. This is not correct. When you add up 0.2 plus 0.23 plus, that's 0.47, 0.65 plus, that's 1.10. Something is wrong. So one of them is not correct. So let's check. Confirm for me which one is not right. Whatever we are going to get should not be more than 1. Have you discovered the area where we have made mistake? So when you add up everything, this is 1.1, whereas it's supposed to be 1.
That 4. It's supposed to be 0.276.
0.27.
That's 0. Yes.
You say it's supposed to be 0.2.
72.
Oh, 272. So that should be 2.7. So 3 plus 2, that's 5. 5 plus 14, that's 19. Then plus 1 plus 2 plus 1, 3, 5, 9, 11. It's still the same thing. Okay, let me try my 427 divided by 2105. Here I got 0.2, which is correct, multiplied by 1. That produces 0.2, correct. Then 482. 482 divided by 2105 equal 0.23, okay, which is correct. Then multiply by 2 equal 0.56, 0.46, rather. Then 467 divide by 467 divided by 2105 equal 0.22, okay? Multiply by 3 equal 0.67, which is correct. Then 574 divided by 2105 equal 0.27 multiplied by 4 equal 1.09, correct. Then 559 divided by 2105 equal 0.27, okay, multiplied by 5 equal 1.33, she's correct. So where is the problem coming from? 0.2 plus 0.23 plus 0.22 plus 0.27 plus 0.27. So 1.19. So something is wrong somewhere. Let's check the total of the present value. 427 plus 482 plus 467 plus 574 plus 559.
It's
So
2509.
supposed to be 2509. Yeah. So that means what we have done is wrong. So this one's supposed to be 2509. Oh, okay. I think this 2109, this 2105 represent the cash outflow. So this is 2509. That's what it should be. So that means all what we have done here are wrong. So let's do it again. That's why it's good for one to know what you are doing. If I did been, we did not consider the total now, we wouldn't know whether what we have done is wrong or right or wrong. Okay, so let's do it again. So 427, yeah, use your calculator now. Let's do it together again.
0.17.
0.17. What you have in your calculator multiplied by 1 will give us 0.17. Next one. Yep.
0.19.
0.19. What you have in your calculator multiplied by 2. Prosper, you can start from year 5 so that it will be faster.
0.38.
0.38.
0.19.
0.19 again. What you have multiplied by 3.
0.56.
Therefore,
0.23.
0.23 multiplied by 4.
0.92.
92. The last one.
0.22.
0.22 multiplied by 5.
1.1.
So 0 points or 1 point what? What do you say is the total? What's the total duration for year 5?
To be confirmed now. 2.1.
The 5, 1.11.
1.11. Okay, so let's confirm the total proportion
It's
So
correct.
0.1 is 1. Okay, then. So at this point, add up the duration together. What do you have? 0.17 plus 0.38 plus 0.56 plus 0.92 plus 0.1.
3.14.
3.14. 3.14 is the duration of the project. So let's use the second method. The second method is weighted average method. So I would then say alternatively, or alternative solution. Here we want to use using weighted average method. Okay. Calculating duration using weighted average method. So you create a column for year, cash flow, discount factor at 13%. Then we have the present value. Then you have the weight. So let's say this is A, this is B, here is C, then here is D. D equal to B multiplied by C, B multiplied by C, then here is E. E equal to A multiplied by D. All right. So my cash flow here 1, 2, 3, 4, then here 5. The first year cash flow is 483. Here is 483, 615, 617, no, 615. Then 674, 937, 1029. So we got a present value of 559 for year 5. Sorry, discount factor first. Discount factor of 0.543, 0.613, 0.693. Then year 2, 0.783, 0.885. Here is 427, 483, 467, 467, 574, then 559. Now we got a total of 2509. Here is 2509. Okay. So let's get the weights. Here will be 427. What's the weight of the second year? Present value multiplied by number of years.
966.
966. The third year,
1401.
1401.
2296.
2296.
2790.
2790. So what's the total? Total weight.
So year 5 is 2795.
2795. Okay. Add up. What do you have?
7,885.
7,885.
885.
Divided by 2509. What do you have?
3.14.
3.14 years. So let's check if the same thing as what we got up. See the same thing you can see. So whether you use present value method or you use weighted average method, you are going to get the same thing. So this is how to calculate duration. I would then say the duration of the projects is 3.14 years. So this means that this project will pay back within 4 years. It means that the project will pay back within 4 years. So this is how to calculate project duration. At this point, we can then move to the last illustration that we want to solve for today. I will stop sharing this. So let me share the question so that we can be speaking on the same page. Now, before we move to the next one, do you understand how to calculate project duration using these formats?
Yes, sir.
All right, then. So I will stop sharing. So let's move to the next one. So this is going to be the final illustration that we are going to have on capital budgeting. Let me know if you can see my screen. Can you?
We can see it, sir.
All right, then. So the last illustration, I think this is illustration number, okay. This question was tested in November 2021, compulsory 30 marks. And for you to do well in this question, you must be able to, you must understand, you must have a deep understanding of performance management. As you can see from the screen, in this question, we have there is labor. We are given direct costs. We have labor. We have material. Okay. We have indirect costs. Not only that, we also have other costs in the question. Therefore, you must be able to identify relevant costs or relevant cash flow before you can do justice to this question. So if that is the case, now, before anything, you need to go to the requirements and check what the expectation of the examiner is all about. In requirement A, you are to calculate the expected internal rate of return associated with the manufacture of VC4. Show all workings to the nearest million, 19 marks. Number B, what is meant by an asset beta and how it is different from an equity beta? Number B2, If you are told the company's equity beta is 1.2, the market return is 15%, and the risk-free rate of return is 8%, discuss whether you would recommend introducing the product. Number C, the company is worried about the government. The company is worried that the government might increase corporate tax rates. Advise the directors by how much that the tax rates would have to change before the project is not financially viable. A discount rate of 17% per year may be assumed for part C. So this is 30 marks question. So number A, you want to calculate internal rate of return. So without wasting more time, let's go back to the body of the question. Okay. Femi Appliances Limited is a Nigeria-based manufacturer of household appliances with many distribution centers across various locations in Nigeria and along the ECOWAS sub-region. FAL is now considering the development of a new motor vehicle vacuum cleaner, VC4. The product can be introduced quickly and has an expected life of 4 years. I will underline this, expected life of 4 years with a more efficient model. Costs associated with the products are estimated to be direct costs, labor, 3.5 skilled labor hours at 500 naira per hour, 4 unskilled labor hours at 300 naira per hour, material, 6 kilos of material Z at 146 naira per kilo, 3 units of component P at 480 naira per unit, 1 unit of component Q at 460 naira. Other variable cost, 210 naira per unit. Indirect costs. Apportionments of management salaries, 10.5 million naira per year. Tax allowable depreciation of machinery, 21 million naira per year. Selling expenses, not including any salaries, 16.6 million naira per year. Apportionment of head office costs, 5 million naira per year. Rental of buildings, 10 million naira per year. Annual interest charges, 10.4 million naira. Other annual overheads, 7 million naira, including apportionment of building rates, 2 million naira. And B, rates are a local tax on property. If the new product is introduced, it will be manufactured in an existing factory and will have no effect on rates payable. The factory will be rented for 12 million naira per year, not including rates, to other company if the product is not introduced. New machinery costing 86 million naira will be required. Okay, I can see initial outlay. The machinery is to be depreciated on a straight line basis over 4 years and has an expected salvage value of 2 million naira. So in this paragraph, I can see initial outlay, I can see scrap value. The machinery will be financed by a 4-year fixed rate bank loan at an interest rate of 12% per year. So I can see cost of borrowing to be 12%. I don't need cost of borrowing to calculate my internal rate of return. Additional working capital requirement may be ignored. So those are the 2 relevant information I need in that paragraph. Move on. The new product will require 2 additional managers to be recruited at an annual gross cost of 2.5 million naira each, and 1 manager currently costing 2 million naira will be moved from another factory where he will be replaced by a deputy manager at a cost of 1.7 million naira per year. 70,000 kilos of material Z are already in inventory and not required for other production. The realizable value of the material is 9.9 million. So in this paragraph, I can see additional labor costs. Here I have additional labor costs. Okay. Then I also have net realizable value. There is net realizable value, or just simply say scrap value. Realizable value. Then we're also given a kilo. We are told that there's a 70,000 kilos of material Z already in inventory. We don't need that one for anything. All right. Far, we use the existing advertising campaigns for its distribution center to also advertise the new products. This will save approximately 5 million naira per year in advertising expenses. That information is not relevant for anything. The price per unit of the product in the first year will be 11,000 naira, and demand is projected at that. Here I can see selling price. There is selling price and then units. Okay. The inflation rate is expected to be 5% per year, and prices will increase in line with inflation. Wage and salary costs are expected to increase by 7% per year, and all other costs, including rents, by 5% per year. No price or cost increase are expected in the first year. I can also see inflation rates. There's inflation rates in that paragraph. Move on. Income tax is at the rate of 35% payable in the year the profit occurs. Okay, there is a tax rate of 35%. Okay, payable in the current year. Tax is paid in the current year. Assume that all sales and costs are on cash basis and occur at the end of the year, except for the initial purchase of machinery, which will take place immediately. No inventory will be held at the end of any year. So this is the question. Examiner wants us to calculate internal rate of return. We want to calculate internal rate of return. What are we supposed to do? Now, pay attention, please. When you are faced with this kind of a question on the day of your exam, please don't make it your first attempt. If you make it your first attempt, you are going to be destabilized. Therefore, take your time, go for the simplest questions in all the sections that have been in section B and section C. If you have pocketed about 2 or 3 questions, then you can then go back to the compulsory question number 1 and take your time to attempt the question. So in this question, you want to calculate internal rate of return. And we know that internal rate of return is the rate that equates NPV to 0. So in that case, what am I supposed to do? And when I was explaining the principle, I mentioned to you that there are basically 3 procedures that you are going to carry out whenever you want to calculate internal rate of return. The first thing first you need to do is to assume 2 discount rates that will produce 2 opposing NPV. That is, one discount rate, you are going to assume 1 discount rate that will give you a positive NPV. Then you assume another discount rate that will give you a negative NPV. Then step 2, you proceed to calculate internal rate of return using internal rate of return formula. Then step 3, you advise whether the project is financially viable. Those are the 3 procedures you need to carry out. However, when you want to calculate your NPV that you are going to use for the internal rate of return, remember there are 3 criteria, factors or determinants or variables that you need to calculate your NPV. One is relevant cash flow. Okay, one of them is relevant cash flow. The second one is useful life. When you are calculating internal rate of return, you don't need appropriate cost of capital because you are the one that will assume the cost of capital. Therefore, the issue of appropriate cost of capital will not apply. Just assume 2 discount rate that will produce 2 opposing NPV. However, the challenge with this question is just the fact that how you are going to identify relevant cash flow. Any other thing you want to do, the cost of capital, the useful life, all those ones are very straightforward. But the challenge you are going to face in this question is how to identify relevant cash flow. Therefore, let's take it one by one. Now, I'm going to teach you the exam technique to answer this kind of a question, because you can't just start. You can't just start and draw your table for NPV and think you want to solve it like that. It doesn't work like that. So first thing first, you need to work out the variables that you are going to need one by one, step by step, okay? From the format you have for calculating your NPV, the first item is sales value. Therefore, I will go to the question, am I given selling price? Yes. If I'm given selling price, is there anything like inflation rate? If I'm given inflation rate, then I need to inflate the selling price. Before I inflate the selling price, I need to know what is the nature of my selling price. Is my selling price stated in first year? Am I given the first year prices or year one prices or current value terms? All those implications, as far as inflation is concerned, you have to consider it, as we have discussed previously. Now, if that is the case, I'll move to the next one after I've gotten my sales. Then, do I have variable cost? Yes, in this question, there is a variable cost, but examiner did not give me variable cost directly because I can see labor, I can see material. What that means is that I need to go and calculate labor cost per unit. I need to calculate material cost per unit. And in labor, there are two categories of labor. We have skilled labor. We also have unskilled labor. You must determine each of them separately. All right. So without wasting more time, so let's quickly go back to our working note. Let's go back to our working note to solve this question. Okay. Let me stop sharing this. Let me know, please, if you can see my screen. Let me know if you can see my screen.
Yes, sir, we can see it.
Okay. Femi Appliances Limited. So I want to calculate. Now, in this question, examiner asks us, in number A, you are asked to calculate internal rate of return. Then that will take for like, let me say, one page. Then number B, we also take another page. Number C, we take another page. All in all, we are going to have 3 pages. Therefore, let's go and start our workings from the 4th page. Okay, so workings. Working number 1. Remember, from the formats, the first item is sales value. Therefore, I will then say sales. I want to calculate sales value for year 1, year 2, year 3, then year 4. I'll go to the question and pick selling price. Let's go back to the question. Okay. Where can we find our selling price? We've already indicated it. So we are told that the selling price per unit of the product in the first year will be 11,000 naira. You can see examiner has given us first year price, meaning that inflation should start from year 2. Okay, remember, I told you when I was explaining inflation to you that when cash flow are stated in year 1 prices or first year prices, inflation should start from year 2. That is, you should start inflating from year 2 because the first year price represents your base year price. Then I also said that when cash flow are stated in today's prices, year zero prices, or current value terms, inflation should start from year one. But in this question, examiner has told us that we are given first year price of 11,000 naira. Therefore, in the first year, our selling price is 11,000 naira. I will then go to the question, what's the inflation rate for selling price? Examiner told us that inflation rate for selling price is 5%. It's expected to be 5% per annum. So I don't need to waste my time. I will just say at 5% inflation. Then I will carry my calculator. I want to inflate my selling price. I will then say 1.05 multiplied by 11,000 equal 11,550 for year two, 11,550. Next year, year three, multiply by 1.05. What you have in your calculator multiply by 1.05, 12,128. Here is 12,128. What you have in your calculator multiply by 1.05 equal 12,774. 12,774. Sorry, 12,734. So with this, I have inflated my selling price. If that is the case, the next thing I need to do is to multiply with the number of units. Okay? I will then say units. Go back to the question. What's the unit sold in the first year? The unit sold in the first year is 12,000, 17,500, 18,000, then 18,500. Here is 12,000 units, 17,500, 18,000 units, 18,500. So at this point, I need to multiply. Our figures. Let's go back to the question. If the examiner was specific by telling us to restrict our numbers to million, yes, you are told that show all workings to the nearest million naira. So our total sales is a million. So if that is the case, what do you now get?
For year one, 132 million.
132.
Yes.
11,550 multiplied by 17,500. Okay. $11,550.
236.
Pardon?
Year 5, 236.
236.
Year two,
Yeah.
202 million.
200
2,125,000.
Did you say 202?
Yes, sir.
Okay. Figures are in million. Then year three.
218.
218. Thank you. So
Point.
that's that.
304. Okay, million, we don't.
Okay. So let me convert the selling price for year three again. So that's 1.05 raised to power 3 equal, then multiply by 11,000. 12,700. Oh, sorry, mistake. 1.05 raised to power 2 equal, then multiplied by 11,000. 12,128. Okay, it's correct. So we are done with sales value. I will then move to working number 2. I want to determine variable cost. In this question, we are not given variable cost directly. So we are given direct labor direct material, and all of that. So the next item, I will go back to the question. I want to determine my variable cost. So the first thing I need under variable cost, I have labor cost. Therefore, I need to calculate labor cost per year, per unit rather. So I would then say labor. In this case, to get my labor, examiner did not give me the first year price, unlike sales, where we are given the first year price of 11,000 naira. But for labor, examiner did not give the labor cost per unit. Therefore, I need to work it out first. So there are two categories of labor. I have skilled labor. Skilled labor. Under skilled labor, examiner told us we are going to need 3.5 hours multiplied by how many was the cost? At 500 naira per hour. Okay, multiplied by 500. So what do you get?
1,750.
1,750 is the labor cost. Unskilled labor. Unskilled labor, we are told that 4 hours will be needed. At what price?
300 per hour.
At 300 naira per hour. So multiply by 300 equal
That will give us
1,200. When you add it together, that's 2,950. So this is the first year price. This represents the first year price for labor. Now that I have the first year price for labor, then I need to inflate. So I would then say year 1, year 2, year 3, and then year 4. Now, labor cost. Inflation rate, we are told that inflation rate for labor cost is 7%. The first year price is 2,950. Therefore, I will carry my calculator. 1.07. 1.07 multiplied by 2,950 equal 1017. What did I do? That's not correct. Oh, I just
31
pressed-
3157.
57.
Yeah, thank you. 1.07. I press something else. Multiply by 2,950 equal 3157. Thank you. Here is 3157. What about the next one?
I don't know how we got that one.
Pardon?
I don't know how we got 3157.
1.07 multiplied by 2,950. Okay?
Okay, so I'm doing
The
it
next
now.
one is 3378.
3378.
78.
3377. It will give you
No.
33. You are using what you have in your calculator. Don't use what you have on the screen. Use what you have in your calculator. Here is 3377.
Okay.
What you have in your calculator multiplied by 1.07.
The last one is
Okay.
3614.
Pardon? 3614. Correct. 3614. So we have inflated the labor cost. So at this point, I need to calculate the total labor cost. Okay, the total labor cost. Number of units for the first year is 12,000, 17,500, 18,000, 18,500. Okay. Then total labor cost. Total labor cost in million. What do you have?
35.5.
85.
35.
Did you say 35.5 or just 35?
354 rather.
35, sir.
35. Next one.
Year 3. Year 3 is
Yep.
60 point. Okay, 60. 60. Let's say 60.
Yeah.
60.
55.
55. Remember, examiner said our number should be to the nearest million, so no
Okay,
point.
okay,
7.
sorry, 61 then. Year 3, 61.
7.
Year 3,
Pardon?
61.
F4.
Year 3, 61.
67.
67, year 4.
Year 3, 61.
Year 3 is 61. 3377 multiplied by 18,000.
61, sir.
Okay. So I'm done with labor costs. I'll move to the next one. Number 3. I will go back to the question. What do you have? The next item is materials. And under materials, there are 4 items. So we have material Z, component P, component Q, and other variable costs. So let's pick them one after the other. So the first item is material Z. Material Z. Now, let's go back to the question. Under material Z, you are told that 6 kilos of material Z at 146 naira per kilo. Therefore, I would then say material at 5% because all other variables are 5% except labor cost. Only labor is 7% inflation. Therefore, for the first year, it will be 146 naira per kilo multiplied by 1.05. 1.05 multiplied by 146 naira equal 153. 153. What you have in your calculator multiplied by 1.05 equal
161.
161. Thank you. What you have in your calculator multiplied by 1.05.
169.
169. So we have inflated the material Z per kilo. So the next item will be for us to multiply the root number of kilos. How many kilos do you need in the first year, year 1, year 2, year 3, year 4? So I would then say kilo needed. So in this question, examiner did not give us the kilo needed. Therefore, you need to work it out. So if that is the case, after I've gotten my kilo needed, then I will create my total cost in million. So at this point, I need to go and work out the kilo needed for the kilo needed. So if that is the case, I will then come here. How do I get the kilo needed? I will come here to say, let me move to the next page. Kilo, actual kilo needed. We want to determine actual kilo needed for material Z. Year 1, year 2, year 3, then year 4. Now, let's go back to the question. Examiner has told us that first thing first, to get the kilo needed, you are supposed to multiply the number of units you have for the respective years. You multiply with 6 kilos because you are told in the question there are 6 kilos of material Z at 146 naira per kilo. So you need to, for you to get the total kilo needed for each year, you are going to multiply the number of units by 6 kilos. So that will give you the total kilo needed. So in that case, I will have units 12,000 17.5. Because material Z is in kilo, not in units. So to get the kilo, you need to convert the unit to kilo by multiply with 6 kilo. Then 18,000. Then here is 18,500. So after this, you now multiply with 6 kilos. There are 6 kilo that will be needed per unit. Therefore, what's the total kilo? 12,000 multiplied by 6 will give us 72,000. Do for the rest.
105,000 for the second one.
105,000.
For the second one, yes, sir.
Yep.
The year 4.
108,000 naira for the third one.
108,000.
Yes, sir.
111.
Okay, 111. All right then. So these are the total kilo needed. So it is all these ones I'm going to use to multiply the price per unit. But in the question, examiner mentioned something where when I was reading, I saw 70,000 kilos. Let's go back to the question. Yes. When you go to the paragraph, when I noted additional labor costs, in that paragraph, you are told that 70,000 kilos of material Z are already in the inventory and are not required for other production. You know, in the determination of relevant costing under material, when I was under material, if you have the material in the inventory, that is the material is in stock, you have already purchased the material, so you have it in stock. So if it is not going to be needed, you are not going to use it. The next thing you are going to do is to dispose it. All right, you are going to dispose it. So the amount at which you are going to dispose it, and that will represent a saving to the organization. So in this question, you are told that 70,000 kilos of material Z are already in inventory and are not required for other production. Therefore, I will then go to my calculation. I have available kilos. Available kilo. 70,000 in the first year. What you have in that 70,000 that you have, you are not going to need it. You are not buying 72 if you have 72 already, if you have 70,000 already in the inventory. Therefore, what's the actual kilo needed? So here will be 2,000. 105, 108, then triple 1,000. So this represents the actual kilo needed. So now that you have the actual kilo needed, you need to go and multiply. I will then go up there. 2,105. Here, kilo needed, 2,000 kilo. 105. 108, I think. Yeah, 108, then triple
108.
Triple 1. So multiply. Multiply, what do you get? Yes. What do you have?
One plus. In
Yeah,
year 1, I have 292.
292, thank you. There is 19. Remember, our figures are in million. So this one will be 0.3. 292 divided by 1 million will give us 0.3 million. Then year 5, I have 19. 161
17.
multiplied by 108,000.
17.
17. Then year 2.
16.
16. All right, so I'm done. So in that same paragraph, you are now told that the realizable value of the material is 9.9 million naira. That's 70,000 material we have in the inventory. If you want to sell it now, the company will realize 9.9 million naira. Therefore, disposal value is a saving to an organization, all right? But as a result of this, the company will not be able to dispose that material because we are going to use it. So in this case, I would then say opportunity cost on material or realizable value. Realizable value, 9.9. Here is 9.9. Add it up. Here is 19, 17, 16, then 10. Rounding. Figures are in million. So this is the total. Okay, that's the total. Because if you go back to the question, examiner told you that 70,000 kilos of material Z are already in inventory and are not required for other production. The realizable value of the material is 9.9, meaning that if the company wants to sell this material Z, this 70,000 kilos, they are going to earn 9.9 million. But because they want to use it for this project, then they are not going to earn that. That represents opportunity cost. Okay? That represents an opportunity cost. So that's that. So I'm done with material Z. The next item is the component P. The next working is component P, number 4. So let's go back to the question. What's examiner saying for component P? We are told that 3 units of component P at 480 naira per unit. 3 units. So here is equal to 3 units multiplied by 480 naira. What do you get? 3 multiplied by 480.
1140.
1140. That's the price per unit. So in that case, I would then say year 1,
1440 rather.
1440, right? So year 2, year 3, year 4. So component P at 5%. First year price is 1440. Therefore, 1.05 multiplied by 1440. What do you get?
15
1 5. Okay.
15.
12.
2.
What you have in your calculator multiplied by 1.05.
158.
1 5.
15
88.
multiplied by 1.05.
1667.
1667. All right then. So at this point, I need to multiply with number of units. 12,000 units, 17,500, 18,000, 18,500. So multiply. What's the
Let's say
total?
17 million.
Pardon?
17 million.
17.
Year 4, 31.
31.
Sorry, sir, was the unit given in the question?
The units are there in the question.
Okay. Okay, all right.
Second year, 26.
26,
Next year, 29.
29. So I'm done with that. So let's go to the next one. Component Q, number 5. Work number 5. Components Q. Under component Q, what are we told? 1 unit of component Q are 640 naira. 1 unit. Therefore, 1 multiplied by 640 equal to 640 for the first year. So I will do for year 1. I will do for year 1, year 2, year 3, then year 4. So components Q at 5%. The first year is 640. So 640 multiplied by 1.05. What do you get? Debbie,
672.
672 multiplied by 1.05.
706.
706 multiplied by 1.05.
741.
741. Thank you. So 12,000 units, 17,500, 18,000, 18,500. Let's get the total.
The first year, 14.
14.
13. Third year. No, the
The
fourth year, fourth.
Okay. The third year, 13.
Fourth year is 14. The third year is 13.
Okay.
First year is 7.
7,
Second year is 12.
12. All right, we are done with that. Next item. Next item is other variable cost, 210 naira per unit. Other variable cost, number 6. Other variable cost. Other variable cost. So year 1, 2, 3, then 4. Other variable costs at 5%. 210 for the first year. So 1.05 multiplied by 210. 1.05 multiplied by 210.
221.
220.
221 multiplied by 1.05.
232.
232 multiplied by 1.05.
243.
243. So let's get the total cost. Total in million. What do you have?
Year 4, 5.
5.
Year 1, 3.
Year 1 is what?
3.
3.
Year 3 is 4.
Okay.
Year 2, 4.
All right then. So we are done with other variable costs. See the way we are moving. Next one, we are done with materials. So let's go to indirect costs. According to the question, the first item under indirect costs, we are told the apportionment of management salaries, 10.5 million naira per year. That item is irrelevant. Anything that has to do with apportionment is irrelevant cost. Therefore, we ignore. Next one, tax allowable depreciation of machinery, 21 million naira per year. That is relevant, but we are going to use it later. Selling expenses, not including any salaries, 16.6 million naira per year. Selling expenses is relevant because if you don't incur the selling expenses, you don't be able to make sales. Therefore, let's go and do working for selling expenses. Working number 7. Selling expenses. For the first year is 16.6. Okay, so year 1, year 2, year 3, and year 4. Selling expenses. At 5% inflation rate. So look, pay attention, please. Remember, our figures are rounded to a million. So this 16.6 million in the first year will be 17 million. But 16.6, when you round it, will give you 17 million. When I now want to inflate for the second year, I'm not going to use 17. I will use 16.6. Therefore, 16.6 multiplied by 1.05. What do you get? What do you get? 16.6 multiplied by 1.05. That's what? That's what?
17.
That's 17.43 multiplied by 1.05
18.
18.
multiplied by 1.05.
19.
19. Thank you. I'm done with that. Total selling expenses rounded to million. Number 8, working number 8. You can see it's a very big question. Number next item, apportionment of head office costs. Like I said, anything that has to do with apportionment is irrelevant cost. Therefore, you ignore. That 5 million naira per year is irrelevant. Ignore it. Rental of buildings, 10 million naira per year. Rental cost is a fixed cost. Irrespective of whether the company execute this project or not, the company will incur the rental of building. So that one is irrelevant. Next item, annual interest charges, 10.4 million. Annual interest charges is irrelevant because the cost of capital to be used for the project already included interest. So if you consider the absolute amount of interest, it will amount to double dipping. Therefore, when you see the naira amount of interest, please ignore. It's irrelevant. Next item, other annual overheads, 7 million naira, including apportionment of building rates of 2 million naira. And B, rates are a local tax on property. So examiner has given to you other annual overheads to be 7 million naira. And you are told that this 7 million naira included building apportionment of 2 million. So what that means is the examiner wants you to do something. Therefore, I need to deduct the 2 million from the 7 million to have 5 million. The remaining 5 million is relevant. I have to account for it. So at this point, I would then say
Please,
other.
sir, I don't understand that point, though.
other overhead. There is an other overhead of, according to the question, of 7 million naira. This 7 million naira included building rates of 2 million with less. So the difference of 5 million is relevant. That's what we have to account for. Wilson, examiner told you that other annual overhead, 7 million naira, including apportionment of building rate. That is, that 7 million naira include an apportionment of 2 million naira. So what that means is that you need to deduct the apportionment embedded in the 7 million. Whatever balance you have thereafter is relevant. All right?
Okay. In that case, if they are giving us just annual overhead alone, that would have been relevant.
No, if you are given annual overhead, you ignore, because examiner did not specify whether it is variable overhead or fixed overhead. Fixed overhead is irrelevant. Only variable overhead is relevant. So since
Okay,
in
this
this
is
question,
variable overhead. Okay, thank you.
so since you are told that annual overhead of 7 million, including apportionment, so it means that you have to, examiner wants you to do something. That's why you are given that 2 million. Had it been in this question, we are not given that additional information. You are just given annual overhead. So I will just ignore because it is irrelevant. It is only when it is variable overhead that you are going to account for it. If you are given fixed overhead will be incurred irrespective of the decision taken on the project, therefore irrelevant. Only variable overhead is relevant. But in this question, because examiner specified by telling you that out of the 7 million, 2 million relates to apportionment of building rates, therefore you less the 2 million from the 7 million, and that's what we have done.
Okay, sir, thank you.
So I would then say other overheads at inflation rate of 5%. Sorry, let me write that. Year 1, year 2, year 3, then year 4. Other overhead at 5%. The first year is 5 million. 5 million multiplied by 1.05. What do you have? That's 5. Prosper, are you still available?
Yes, I'm here, sir.
I've not been hearing your voice. 5.5, that's 6. Multiplied by 1.05. That's 6 also. So I'm done. Here is 6, 6, 6, 6. Okay. Number 9, working number 9. It's a big question. So you have to take it one after the other. If the new product,
Yes, sir.
yes, talk to me.
Please, why do we have 6666?
It's what we have to use your. Oh, sorry.
It's a coincidence.
I was thinking about you, Prosper. That's why. This is supposed to be 5. Error of mind. Okay. Yeah. Thank you for bringing that up. All right, then. Next item, please. Yeah, next paragraph. If the new product is introduced, it will be manufactured in an existing factory and will have no effect on rates payable. The factory could be rented for 12 million naira per year, not including rates, to another company if the product is not introduced. How do we treat that information? We are told that if the new product is introduced, it will be manufactured in an existing factory and it will have no effect on the rate payable, okay? The factory could be rented for 12 million naira per year, not including rates, to another company if the product is not introduced. This is called opportunity cost. Now we have opportunity cost on rents because the company cannot earn that 12 million because they are going to use that space for the project. opportunity cost on rents, 12 million naira per annum. If not because of this project, the company would have rented the place for 12 million naira, but they cannot rent it out because of this project. Therefore, it's a benefit forgone as a result of undertaking the project. That's opportunity cost. So opportunity cost at 5% inflation. The first year is 12. So 12 multiplied by 1.05, what do you get?
13.
13 multiplied by 1.05. Yeah,
13, sir.
13.
14.
Thank you. So we are done with that. Move to the next one. So if we are able to finish our workings, every other thing will just be flowing smoothly. So the most tedious one is what we are doing currently. Next item. New machinery costing 86 million naira will be required. That's initial outlay. The machinery is to be depreciated on a straight line basis over 4 years and has expected average value of 2 million naira. So we are going to need that information later on. So that paragraph for now is not useful. So we are going to come back to that one later. The next paragraph. The new products will require 2 additional managers to be recruited at an annual gross cost of 2.5 million naira each. So let us go and work that one out. Additional manager, additional labor cost will be incurred. Working number 10. Additional labor will be required. So we are told that 2 managers. Let's go back to the question. 2 additional managers. Okay, I would then say managers 2 at 2.5 million naira. That's 5 million. Then move on. We're also told that and 1 manager currently costing 2 million naira will be moved from another factory where he will be replaced at a deputy manager by a deputy manager at a cost of 1.7 million naira per year. The manager that earns 2 million naira, that 2 million naira is irrelevant. What is relevant is the replacement cost of 1.7 million naira per year, because you are told that 1 manager currently costing 2 million naira will be moved from another factory where he will be replaced by a deputy manager. So that 2 million naira is irrelevant, but this 1.7 million naira as a replacement cost is relevant. Therefore, I would then say manager. Let me see the deputy manager. Here is deputy manager. 1 multiplied by 1.7 million. Here is 1.7. Add the 2 together, that's 6.7 million naira per annum. Therefore, year 1, year 2, year 3, then year 4. So additional labor cost, additional labor at 7%. Remember, the inflation rate for labor is 7%. 6.7 will be 7 million in the first year, rounding. Therefore, 6.7 multiplied by 1.07, what do you get? Yes,
7.
that's 7 multiplied by 1.07
8.
multiplied by 1.07.
8.
Thank you. That's it. I'm done with this. Total. Okay. Let me write that. Look at only one question since.
Son, year one is 7.
Yes. Oh, it's like my eyes have started seeing why. 7. Thank you.
Okay, sir.
Okay, next one. Yeah. Okay, we've treated that paragraph. Then the next one, you're now told that while we use the existing advertising campaigns for its distribution centers to also advertise the new products, this will save approximately 5 million naira per year in advertising expenses. So that information is irrelevant because since the company is not incurring advertising expenses, therefore the 5 million naira will not be spent. So it will be saved. It's irrelevant, so you ignore. Then what else? The next paragraph, where you have selling price and units, we've already treated that. Then we have tax. So the next item now we need to work out is our tax saved on capital allowance. So let us go and calculate tax saved on capital allowance. Working number 11. Can imagine 11 workings. That's a lot. Tax saved on capital allowance. Okay. How are we going to treat this? Let's go back to the question. How do we treat the capital allowance? We are told that income tax is at the rate of 35% payable in the year the profit occurs. Assume that all sales and costs are on cash basis and occur at the end of the year, except for the initial purchase of machinery, which will take place immediately. No inventory will be held at the end of any year. So where do you have information on capital allowance? Where do you have information on capital allowance? Okay. Yes. According to the question, where you have indirect costs, you are told that tax allowable depreciation of machinery, 21 million naira per year. So examiner has given you capital allowance to be 21 million naira per year. So if that is the case, how do they arrive at the 21 million naira? The capital allowance, according to the question, we are told is 21 million naira per annum. So how do they arrive at that 21 million? You know the cost of the project. Capital allowance is the cost. Let me rewrite this so that in case you are not given directly, you will know what to do. Capital allowance represents cost minus scrap value divided by the useful life. Okay. In this question, the cost of the project is 86 million naira minus scrap value. How much is scrap value? How much is the scrap value? I noted, yes, scrap value is 2 million. Expected salvage value is 2 million naira. Therefore, I would say minus 2 million divided by useful life of 5 years, 4 years rather. So this will give us 21 million naira. So this is how examiner arrived at the 21 million naira per annum. Now that you have the capital allowance, you need to calculate tax saved on capital allowance. I will then say tax saved. Tax saved on capital allowance is capital allowance multiplied by company tax rates. Therefore, 21 million naira multiplied by the company tax rate is what percentage? 35%. So what do you have as annual tax saved on capital allowance? What do you have? 21 million multiplied by 3.35%, 0.35.
I have 7 million.
That's 7 million rounding. It's approximately
Yes.
7 million per annum. Okay, we are done with that. We are done with our tax saved. So at this point, we can then go back and be doing, and then since we are done with all relevant workings, okay, let me see. We are done with all relevant workings. At this point, we need to go and post. Let's go and post our figures. It's a big one, very stressful. So primary appliances. I would then say, now, examiner wants us to calculate internal rate of return. For you to be able to achieve that, you need to determine, because this is a big question, so you need to first of all determine your net cash flow, because we have so much multiple variables. So I would then say calculating net cash flows. Because once I have my net cash flow available, I can use it to calculate I can use any technique to calculate. Our figures are in millions. So in this question, I have for year 0, year 1, year 2. Let me write that. Year 1, year 2, year 3, year 4. Then you introduce a column for workings. I don't know the extent my table will take, but I have sales value, working number 1. I have labor, working number 2. I also have material Z, working number 3. I have components P. Let's check. Labor, material Z, component P, then component Q, other variable cost. Okay. Components P, components Q, other variable cost. Other variable cost. This is 4, 5, then 6. After other variable costs, we also have selling expenses. Let me see. Other variable selling expenses, other annual overhead, then opportunity cost. Selling expenses. Other overhead, opportunity cost, on rent. Okay? I don't want you to interfere with the year zero. Okay? Then after opportunity cost, of course, this is working number 7, 8, 9. Working number 10 is for what's working number 10? Additional labor. Okay? Additional labor. Additional labor cost. That's working number 10. So at this point, after this, I'm going to have profits. After profits, I will pay tax at 35%. Then after that, I will consider tax saved on capital allowance. Then I will consider scrap value. Then thereafter, I have the initial outlay. Remember, we have a format. There is no working capital, therefore you ignore. So once I have my initial outlay, the next item will be the net cash flow. So with this net cash flow, I can use it to calculate anything. You can see how long it is. So let's draw our table. I have to manage. My hand is not straight. I'm not using ruler. Manage it like that. Okay. All right. Net cash flow. All right then. So let's go and be picking the numbers one after the other. So sales value. Or do you have the number with you? Debbie, do you have the number for the workings we have done with you?
Yes, I'll have the number, sir.
Oh,
I
yeah.
don't know.
So please be calling it for me. Sales, year 1, 132. Am I correct?
Yes, sir. 202 year 2.
02 218
Hold on,
1883
hold on. Year 1 is 132. Year 2 is what?
202.
Next,
218
next,
236
236. What about labor?
35
35,
55
55,
61 67
67. Thank you. Material Z,
10
10,
16
16.
16
Uh-huh.
17 19
17, then 19.
17, 19.
Okay. So component P,
17,
17,
26,
26,
29,
29, and then
31.
31. Component Q,
7,
7,
7,
another 7,
12. No,
12,
7, 12, 13,
7, 12, 13,
14.
and then 14. Other variable costs.
3, 4, 4, 5.
I'm coming. 3,
4, 4, 5.
4, 4, 5. Okay. Selling expenses.
17, 17,
17, 17.
19, 18,
Uh-huh.
19.
18, 19. Other annual overheads.
5, 5, 6, 6.
5, 5, 6, 6. Opportunity costs.
12, 13, 13, 14.
12, 13, 13, 14. Additional labor.
7, 7, 8, 8.
7, 7, 8, 8. So let's get the profits. Let's get the profits.
I'm adding up year 3.
Okay.
Year 4 is 53.
5, 3, year 4.
Year 2 is 47.
47, year 2.
Year 3 is 49.
49,
Year 1 is 19.
19. So we are told that tax is paid in the year profit is earned at 35%. So what's 35% of 19?
$6.7.
27.
That's 7.
16 for year 2.
16 for year 2.
Yeah.
17 for year 2.
17 for the 3.
17.
19 for year 4.
19. So tax saved on capital allowance will follow the patterns of the tax liability. Since tax liability is in the current year, the tax saved on capital allowance must also be in the current year. And tax saved is 7 million naira per year. 7, 7, 7. That's working number 11. Scrap value is 2 million naira in the final year. Then initial outlay is 86 million. Therefore, give me the net cash flow. What's the net cash flow? This one should be 19.
For year 3, the next one 38.
38 for year 2.
Year 3 is 39.
39.
41.
41. Are you sure it's 41 year 4? Five 3 plus 9, that's 62. 62 minus 19. Debbie, what do you have in year 4?
43. 43.
4, 3. Okay. All right then. So if that is the case, now that we have the net cash flow, we can then proceed to calculate internal rate of return. I would then say calculating internal rate of return. Remember, with this net cash flow, you can use it to calculate anything. If you like, you can calculate net present value, you can calculate modified internal rate of return or internal rate of return or adjusted present value or project duration, whatever technique that you want to use to ascertain the financial viability of the project, you can use this net cash flow to do it. So if that is the case, since the examiner asks us to calculate internal rate of return, the next thing I need to do now is to assume two discount rates that will produce two opposing NPV. I would then say assume. Now, before you assume your discount rates, you have to be very careful so that you don't just be doing iteration. When you look at the cash flows, when you look at the net cash flow, you will see that our cash inflows is almost double the cash outflows. When you add up 19 plus 38 plus 39 plus 43, it's almost double the 86 million cash outflow. What this means is that if you assume 5%, 10 or even 10%, that may likely be, you'll just be doing iteration. So let us start from 15% and see. So assume 15%. In this case, I will then change my format for calculating the NPV. I will say I'll create a column for year, cash flow, discount factor at, then I will have present value. Presentation is very important. Good presentation. Here is 15%. Therefore, year 0, 1, 2, 3, 4. Okay. So my NPV. Year 0. My net cash flow is 86 million. Followed by year 1, 1938. 19, 38, 39, then 43. Therefore, what's the discount factor for year 1 at 15%? Yes.
0.869.
0.870. Year 2,
0.756.
756. Year 3,
0.658.
658. Year 4,
0.572.
0.572. So let's multiply. 19 multiplied by 0.87. 19 multiplied by 0.87. What do you get?
16.5.
16.5. That's 17. Next. 38 multiplied by 0.756.
29.
29. 39 multiplied by 0.658.
26.
43 multiplied by 0.572.
25.
25.
25. So 25 plus 26, that's 51. 51 plus 29, that's 80. Right?
And total is 97.
97 minus 86. 11 positive, right?
Yeah.
So we assume 15% we got a positive NPV. Let us assume a higher discount rate. So let's assume 20%. So at 20%, here is 1. What's the discount factor for year 1 at 20%? Yes. 1.2 raised to power minus 1.
833.
0.833.
0.694.
694.
0.579.
579.
0.482.
482. Thank you. So let's get the present value for 20%. 0.833 multiplied by 19. Yes.
The fourth year, 21.
21.
First year is 14, sir. Year 1.
14. 14.
Year 3 is 23.
2, 3.
Year 2 is 20.
20.
Yes, sir.
So 14 plus 20 plus 23 plus 21. What do you get?
78.
78.
Something is not right. Let's check our
Year
numbers.
3, year 2 is 26, not 20.
26. So what then do you have?
84.
Something is not right. Let's check again the accuracy of the numbers.
Year 2 is not 26, so
38 multiplied by 0.694.
okay.
Now year 1 is 16.
Year 1 is 16. That's 19 multiplied by 0.833. That's 16. not 14.
16. Sorry.
This is 16. So what do you have as your total?
86.
86 minus 86 will give us 0, right?
Yes, sir.
So you have to be very careful on the day of the exam. You must ensure that you are picking the right number so that you don't make costly mistake. You know, so you'll be thinking that you are putting down the right number, not knowing that it's wrong. So we assume 15%. To save time, I will say we assume 15%, and the 15% produce NPV of 11 million naira. We assume 20%, 20% produce NPV of 0. And you remember the definition of internal rate of return. We state that IRR is the rate of return that equates the present value of future cash flows to 0. That is, any discount rate that produce 0 NPV is your internal rate of return. So with this, there will be no further calculation for internal rate of. We've already gotten what we are looking for. In that case, I would then say the projects they assume discount rates of 15% and 20% respectively produced the assumed discount rate of 15% and 20% produced a positive NPV or an NPV produce NPV of 11 million naira and 0. Respectively. Since internal rate of return is the rate that equates net present value to 0. Therefore, the IRR, of the projects is approximately 20%. So no further calculation is needed for that. So that's that. That's end of the requirement number A. Let's quickly go through requirement number B. Requirement number B, you are asked, what is meant by an asset beta and how it is different from an equity beta? What the examiner simply wants you to do here is to define what asset beta is all about. Once you are able to define that, then you also define equity beta. So if that is the case, what do you mean by asset beta? What is asset beta? What is equity beta? So quickly, so what are you supposed to do? Prosper, Do you remember the definition of asset beta? Remember we did it when we had the cost of capital under project specific. Right? What do you understand by equity beta? Yes? Do you want to try? Debbie, what's equity beta? Debbie, what's equity beta? Answer me.
Sir,
Why is
can I
every
attempt?
one of you silent? Because I'm asking you a question now, you are
Sir, can I
silent. Now that I'm asking you question, you are silent. I beg, give me question. Answer my question. What is asset beta? We've done it, isn't it? We've done it
we
previously.
have we did
Abu,
the Sir, can I attempt my
what's
understanding?
equity beta? Sorry, asset beta first. Yeah, attempts.
Okay, so I think asset beta is a combination of the equity beta and the debt beta of an organization. That is the total sources of finance of the organization's capital.
Okay, it's all right, no worries. Because of time, it's almost time to end this class. So let me quickly provide that. I won't write it down because of time. You know, when I took you project specific cost of capital, I mentioned to you that asset beta is also known as on-gear beta, which measures only business systematic risk. Okay? Asset beta is an on-gear beta, which measures only systematic business risk. And I also define for you equity beta. And I said that equity beta measures both business and financial risk. And it contains both business and financial risk. So how do you then define this according to what examiner is asking you? So you are going to say asset beta is also known as on-gear beta, which measures only systematic. On the flip side, equity beta measures both systematic, business, and financial risk, and is usually greater than the asset beta because it contains both business and financial risk. Since unsystematic risk can be diversified, the focus is generally on the systematic risk. So that answers number B1. Let's move to number B2. In number B2, examiner is asking, if you are told the company's equity beta is 1.2 and the market return is 15% and the risk-free rate of return is 8%, discuss whether you would recommend introducing the products. All right, so what are you supposed to do in this situation? Very simple. Examiner has given you the information to calculate capping. So the first thing you need to do is to calculate the capping of the project. Once you get the capping ready, then you can now, examiner is now asking you in that requirements to discuss whether you will recommend introducing the projects. You can only recommend introducing the projects if it is appropriate. Remember, when you calculate capping, Capping is just cost of equity. Cost of equity does not consider the financial risk associated with the project. So it doesn't consider itself with other parts of financing, which it has to do with debt. So if that examiner is now asking you to discuss whether you will recommend introducing the product. So as a result, because of time, what I will then do, if I'm the one solving this question, what I will do is to first of all calculate the cost of equity. Once I have the cost of equity ready, then I can be able to advise. Therefore, let us quickly calculate the cost of equity. So number B2, B, Roman figure 2, calculating cost of equity. Using capping. So, and you know capping, cost of equity equal to risk-free rate of return plus the beta into market return minus risk-free rate. So according to the question, we are given a risk-free rate of what? What's the risk-free rate of return given to us? 8%, right? We are given a risk-free rate of return of 8%, beta of 1.2, the market return of 15. So here is 8 plus 1.2 multiplied by 15 minus 8. So what's our cost of equity? Debbie, give it to me. What's our cost of equity? We have to complete this question. No carryover. What do you have? What's our cost of equity, please? 1.2 multiplied by 7 plus 8. What do you get?
64.4. That's 64.
16.4%. Approximately 16%.
Not 16, 64. 64.4.
How do you arrive at 64?
9.2 times 7.
No, now. 15 minus 8 is 7.
Yes, sir. Times 9.2.
It's not 9.2, it's 1.2.
Okay, something together.
1.2.
But there's 8. What about the 8, sir?
8.
Yeah, I thought it's 8 plus 1.2.
So you are going to start from 15 minus 8 multiplied by 1.2. What's 15 minus 8? What is 15 minus 8?
7.
7, right? Multiplied by 1.2. What do you get?
8.4.
8.4 plus 8. What do you get?
16.4.
That's it. All right? That's it. So if our cost of equity is 16%, so examiner is now asking you to discuss whether you will recommend introducing the products. So what should be our solution, our further discussion? So I would then say the company's required rate of return of 16% as calculated above relative to the project. What's the project's internal rate of return? We got 20%, isn't it? Hello, are we together?
Yes, sir. Yes, sir.
Our internal rate of return is 20%. And the cost of equity we calculated is 16%. So examiner is now asking you to advise whether you will recommend, let me open, discuss whether you will recommend introducing the products. Therefore, to answer that, I would then say the company's required rate of return is 16% as calculated above. relative to the project's internal rate of return of 20%. The product appears financially viable and should be undertaken. However, other factors may need to be considered before the final decision is taken. Okay? Now, remember the decision rule under internal rate of return. We said that for independent projects, accept if internal rate of return is greater than the company cost of capital, isn't it? Then for mutually exclusive projects, we said accept any project with a higher internal rate of return, provided it is greater than the company cost of capital. Therefore, we have calculated cost of capital to be 16%. Then we calculated internal rate of return to be 20%. Since internal rate of return is greater than the company cost of capital, the project is recommended to be financially viable and should be undertaken. That's that. But is that what we are going to say? There should be additional information we need to add to that, because cost of equity is not really the main cost of capital. When you say cost of capital, what we simply mean is the weighted average cost of capital. So as it is now, it is assumed that this company is only financed with equity. If we are to base our discussions on the cost of equity of 16%, so there is a limitation associated using capping. Therefore, according to this question, for us to be able to earn our full marks, how many marks is given to that? 4 marks. For us to be able to earn the 4 marks under requirement B2, we need to negate some assumptions of capping. So because of time, let's continue from where I stopped. So after advising that the project is financially viable and should be undertaken, the next thing you should say is that, however, other factors may need to be considered before final decision is taken, including 1, project risk. 1, project risk. What do you mean by project risk? So let's explain. The cost of capital should be consistent with the risk associated with a project. Cost of capital should be consistent with the risk associated with a project. Hope you are writing. Continuation. The company's cost of equity beta. The company's equity beta of 1.2 indicate that the risk associated with the business is higher than the risk of the market, since the beta of the market is always 1. You see, when we get to capital as a price model, we are going to talk in details what beta value is all about and how to determine expected return of a risky asset. So when we get to capping as a topic, we are going to discuss that in detail. But however, as far as this requirement is concerned, we're just trying to buttress our points on whether the company should, whether we should recommend introducing the product. We have recommended already that the project is financially viable, considering the fact that the cost of capital of 16% is lower than the internal rate of return of 16%. So I'm now saying that that is not sufficient for you to earn that 4 marks. You need to explain further, because the cost of capital we have calculated of 16%, we only consider the cost, that is cost of equity. We did not consider the other part of work, which has to do with the debt. So for us to do more on that, we need to talk about the project risk. We talk about the appropriate cost of capital. Then you also talk about issues arising or issues associated with the capping. So under the project risk, what I'm saying is that an answer, you should put it down in your writing, put it down, you write it out. cost of capital should be consistent with the risk associated with a project. The cost of equity beta, the company's equity beta of 1.2 indicate that the risk associated with the business is higher than that of the market, which is always 1. Now, the beta of the market is always 1. Since the beta of this product is 1.2, it means that the product is more risky than that of the market. However, it is important to note that the beta of the product is not available. And in order to arrive at a reasonable conclusion, ordinarily examiner would have given to us the beta of the product. But we are given the beta of the company. So we need the beta of the product for us to be able to advise, to arrive at a reasonable conclusion. Then that's on the project risk. We can also talk about appropriate cost of capital, saying that appropriate cost of capital is required to discount the expected future cash flow associated with a project for the purpose of determining its financial viability. Remember, when you want to determine financial viability, you need relevant cash flow. You need appropriate cost of capital. You also need the useful life. Therefore, this appropriate cost of capital must be available before you can determine the financial viability of a project. So you can then say that the rate of return or cost of equity of 16% is not the same as the company's overall cost of capital, except the company is only financed with equity. Okay? The 16%, I repeat, the rate of return of 16% is not the same as the company's overall cost of capital, except the company is only financed with equity. So you need to consider the debt aspect of the financing. Though there is no indication in the question that suggests the company has debt in its capital structure. You can see in this question, examiner did not tell us that the company has debt in the capital structure, except for the bank loan arising from the method of financing the machinery. Okay, I think it's 8%. According to the question, we have, there's a place examiner mentioned 8% when I now said that we don't need, yes, 12%. We are told that the machinery will be financed by a 4-year fixed rate bank loan at an interest rate of 12% per year. So we don't need that information for anything. However, yeah, that's that. So if the company is financed with debt capital, then the cost of equity will not be appropriate to evaluate the investment opportunity. So in this case, this 16% we have gotten that we calculated as cost of equity is not appropriate because it is not the same thing as the company's overall cost of capital, except if the company is only financed with equity. Then lastly, on that, we also need to talk about capping. We have used capping to get the cost of capital for the product or for the project. Capping has its own limitation, and the limitation of capping generally is on the assumptions of capping, because most of the underlying assumptions of capping, including the fact that all investments are indefinitely divisible, okay? Including the fact that all investments are infinitely divisible, or the fact that homogeneity expectation of investors, which is not possible, and that there is no transaction cost and taxes. All these assumptions are not realistic. These are some of the reasons why the capping model, capitalized pricing model, has been subjected to criticism in pricing risky assets and the determination of cost of capital. because of the limitation arising from the assumptions of CAPM, there are so much criticism, all right, on the model in pricing risky assets and determining cost of capital. So these are the things we are going to do in that number B2. So for you to be able to hang your, it's not compulsory, you must do it in details like this, just as a bullet point, okay, as a bullet point, few line items, okay, and then you move on from there. So that's that. In that number C part of the question, examiner is asking you to determine sensitivity margin of tax liability, okay? Because I don't want us to carry this over. In the next 5 minutes, please lend me additional 5 minutes to complete this. So in number C, the company is worried that the government might increase corporate tax rates. Advise the director by how much that the tax rate would have to change before the project is not financially viable. A discount rate of 12% of 17% per year may be assumed for part C, 5 marks. So in this case, examiner is asking us to calculate sensitivity margin of tax liability. What are you supposed to do? Very simple. The first thing I need to do, for you to be able to calculate your sensitivity margin of tax liability, you need the NPV. You know, it should be NPV divided by the present value of tax liability. So what that means is that I need to calculate my tax liability first. Once I have my tax liability available, then I will then go ahead and calculate the PV of the tax liability. Once I have the PV of the tax liability, I already have my NPV. Okay, I already have my NPV. So once I have the NPV of the tax liability, then of course, NPV of the project using the 17% as given to me, then I will then go ahead and calculate the sensitivity margin. So quickly, let's solve this and so that we can close the class for today. All right. So I want to calculate sensitivity margin of tax liability. All right. I would then say number C, calculating sensitivity margin. When we get to risk and uncertainty, we are going to do sensitivity margin in details. Sensitivity margin of tax liability. So like I said, to answer this question, the first thing first you need to do is to calculate the net present value of the project using the cost of capital of 17% as given to us in the question. Because examiner is saying that you should assume a discount rate of 17% per year. Okay? So if that is the case, you are just going to discount your your net cash flow we have computed before by that 17%. All right? Discount it by that 17%, and that's all. So let's quickly do that. I will then say calculating NPV before I can get the sensitivity margin. So calculating net present value. To do this, I have year 0, year 1, year 2, year 3, then year 4. So I have the net cash flow. Here is 86. Debbie, what's the net cash flow for year 1? What's the net cash flow for year 1? 19, 38, 39, 43. 19, 38, 39, 43. Okay, then examiners ask us to use discount factor of 17%. So give it to me. What's the discount factor for year 1 at 17%? Yes, 1.17 raised to power 4 minus for year 4, that's 0.534. 0.534. Debbie, are you not there? Prosper.
I was having network issue. I just came back online.
Oh, okay. Prosper, Wilson, where are all of you? Are you tired? 1.17 raised to power 3 minus for year 3, 624. 0.624. Year 2, 1.17.
0.7.
0.71.
731.
731.
731. Yes.
0.731. Then it will be 0.8 watts. Yep.
0.855.
855. So multiply. Let's get the present value. What's the present value? Let's hurry up because of time. Here is 86 PV. Yes. PV of year 1.
PV of year 2 is 27 or 28.
Year 1 is 16.
16.
Year 2, 28.
28. Yes.
Year
Year
4
3
is
is 24.
24. Then year 4 is what?
23.
23. So add up. What's our NPV then? 23 plus 24 plus 28 plus 16 equal minus 86 equal. Give me the final number.
5, sir.
5. Our NPV is positive 5. Our NPV is positive 5. So with this, now that we have the NPV ready, then we need to go and calculate the PV of tax liability. Let us go and calculate PV of tax liability. That should be step 2. I will then say calculating present value of tax liability. Okay. Year 0, 1, 2, 3, then year 4. So in the question, in our solution, we have tax liability, we also have tax saved. So the difference between what we are going to determine, what we are going to take is the net tax. So in the first year, we have tax liability. Okay. We have tax liability of how much? The first year tax liability is 7, isn't it? 7, right?
Yes, sir. Yes, sir.
So the first year tax liability is 7. There's no tax liability in year 0, so I will say tax liability in the first year is 7. Year 2, what about year 2?
16.
16. Year 3?
17.
Year 4?
19.
19. So we are going to less the tax saved on capital allowance. What's the tax saved in the first year? 7, right? Isn't it?
It is, sir.
Yeah, so 7 all throughout. This one is brackets, brackets, brackets. 7, 7, 7. So what's the difference? Here is 0. Here is 9. Here is 10. Here is 12. So this represents the net tax that the company will pay. That's tax liability after capital allowance or net tax liability. So let's call this one tax liability after capital allowance. So we need to discount this. Let us discount that at the appropriate cost of capital. What's the cost of capital? We are given 17% cost of capital. Therefore, we've already determined the discount factor, this one to be 0.85, 855, 0.731. Let me rewrite that. Then 0.624, 0.534. So give it to me, the present value. Give me the present value. Here will be 0. So what do you have?
The 2 is 7.
Here 2 is 7. Okay. 7. Next one,
The 3 is 6.
6. What about here 4?
6.
6. So what's the total? 6 plus 6, that's 12, that's 19. Total is equal to 19. All right. If you like, you can total all of that at the end of the day. So we have a 19. So that represents, because of time, let me just do this one. So that's total PV of tax liability. So that's total PV of tax liability. Now that I have the PV of tax liability, what am I supposed to do? I will just go straight and calculate my sensitivity margin, and that's all. That's the end of the question. So because the examiner is asking me by how much that the tax rate will have to change before the project is not financially viable. That simply means sensitivity analysis. So examiner wants us to calculate the sensitivity margin of tax liability. So at this point, I would then say calculating sensitivity margin of tax liability. Sensitivity margin of tax liability, which is calculated as the net present value divided by the PV of tax liability, all multiplied by 100 over 1. So the NPV, we got 5. We calculated NPV to be 5, okay? Then the PV of tax liability is 19. Divided by 19, multiplied by 100 over 1. What do you get? 5 divided by 19. What do you have?
26. Sir.
Pardon?
26.
26. Okay.
26%.
26%. Thank you. Okay. Here is 26%. Therefore, you need to interpret this. What this means is that the tax liability can increase by up to 26%. Anything above that 26%, the project will become unviable. This is the percentage that will make the project to break even. The company will not make profit, will also not make any loss at this point, at this 26%. Anything above this 26%, the project will not be financially viable. Therefore, we then say the tax liability should not be allowed to increase beyond 26%. Otherwise, the project will not be viable. Okay, let's put it down. Because each time you compute your sensitivity margin, you are supposed to interpret your results. So we then say the tax liability should not be allowed to increase beyond 26%. If not, the projects or products will not be financially viable. That's it. That's end of the question.
So
That's
please,
end of the... Yep. Talk to me.
so please, can you explain like this, the meaning of this sensitivity and margin again?
Yes, like I said, when we get to risk and uncertainty, we are going to discuss sensitivity margin in details. However, when you talk about sensitivity analysis, it's also known as a what-if analysis. It measures the degree or the extent to which a project NPV can accommodate any change in variable. When you talk about variables, you can say initial outlay, cost of capital, scrap value, sales volume, contribution, project life. Those are some of the variables that is associated with a project. So if you want to know what is the percentage change in any of those variables before the project will become unviable, what if my initial outlay increased by specific percentage? Can the project still be viable? What is, like in this case, what if my tax liability increased by specific percentage? Can the project still be viable? So when you want to calculate sensitivity margin of variable, there are three different formulas that you can use depending on the variable that you want to compute for. For all the variables, except cost of capital and then the project life, this is the formula you are supposed to use. NPV divided by the present value of variable. Since we are calculating sensitivity margin of tax liability, that's why we use tax liability, PV of tax liability as the denominator here. Okay? We use PV of tax liability as the denominator. Say, for example, you want to calculate sensitivity margin of contribution. It will be NPV divided by the present value of contribution. If I want to calculate sensitivity margin of variable cost, it will be NPV divided by present value of variable cost. All right. So in this question specifically, examiner wants us to determine to what extent can the project accommodate. We are told in the question to advise the directors by how much that the tax rates would have to change before the project is not financially viable. So like I mentioned in the definition of sensitivity analysis, I said that sensitivity analysis measures to what tolerable extent can a project NPV accommodate any change in variable. So since the variable in this case is tax liability, so what you need to do is to compute present value, because examiner says you assume a discount rate of 17%. So what this means is that you need to calculate the NPV of the project using 17%. Then you also calculate the present value of tax liability. Once you have those two available, then you can then go ahead to calculate the sensitivity margin of your tax liability, which is what we have done, and we arrive at 26%. So as it is, now that we have the sensitivity margin, it is not enough for you to just calculate 26%. You need to interpret your results. You need to interpret your results. So what this simply means is that our tax liability can increase up to 26%, can increase additionally by 26%. Anything above that 26%, the project will not be viable again. This NPV that is showing 5 naira or that is showing 5 million, it will now be negative. So it is this 26% that will make the NPV to be equal to 0. That is, it will break even. When you talk about sensitivity margin, it simply means break-even point. Break-even point. All right. I hope that is clear. Prosper.
Yes, sir, it is, sir. Thank you, sir.
You're welcome. So, any
Sir,
other
I have a
question?
question.
Talk to
How
me.
did you get the tax liability of 7, 16, and 17?
Tax liability of 7.
Yes.
Is there? We've computed it before now. You know, in the question, in our solution, our tax liability. Remember, we calculated tax liability of 7,
Okay, I've seen
16,
it, sir.
17. So that's that.
Thank you, sir.
You're welcome. So any other question before we close the day?
Sir, you mentioned the other name of sensitivity analysis. Sorry,
Don't
can you?
worry. When we get to risk and uncertainty, we are going to discuss that in details. I said another name for sensitivity analysis is what if analysis.
Okay. Yeah.
What
Thank you,
if
sir.
or swift test analysis. Yeah. So when we get to risk and uncertainty, we are going to do it in details. All right. So in the absence of no further question, this is where we are going to call it a day. And then by the grace of God, in our next class, we are going to be starting free cash flow and then the adjusted present value. I need you to go ahead and read free cash flow and then adjusted present value. Thank you guys for your time and
Sir, can you
understanding.
send the material ahead of the class?
No worry, I will do just that. Okay?
sir. All
All
right,
right,
sir.
thank you to all of you. Abu, Zainab, even though I did not hear your voice today,
All right, sir.
bad.
Good night, sir.
Good night, Abu. Zainab, I did not hear your voice today. No worries. Good night, everyone.